Hello friends, uh, my name is Sandip Agarwal. So welcome to my YouTube channel Financial Markets by C. Sandip Agarwal. So this is video number 4 under Options Intermediate part 2. We have already covered till now 3 videos under Options Intermediate part 2 and 4 videos each under Options Basic and Options Intermediate part 1. So this is the 4th and last video under Options Intermediate part 2. After this, we will start Options Advanced series where we will have another 4 videos. So in totality, there will be total 16 videos under the Options series, and then I will conclude this learning module on the Options series. If anybody wants to learn Options Basic to Advanced, they can see my entire 16 videos under distributed under 4 parts. I hope you people have been liking my content till now, and my videos are adding value. In case you feel that my videos are adding value to you, please like and subscribe to my channel so that you can get notification for any future videos which will be uploaded in future. Also, share the channel link with your family and friends in case you feel that these videos would add value to them as well. So let's start. As I explained in my earlier videos that the option pricing are basically determined by the 5 factors, which are basically option rings: delta, gamma, vega, theta, and rho. And the option pricing of any particular strike price has basically got the 3 components. One is vega, which is basically IV or implied volatility or VIX. Second is theta, which is basically time value of money, and third is rho, which is basically the interest component. And delta and gamma determines how the option price moves upwards or downwards depending on the movement in the underlying instrument price. So in the previous video, I have discussed like what is IV or implied volatility or VIX and what is volatility smile or vol smile. In this video, I will cover these 2 aspects. One is how you can measure that what is the actual volatility based on the historical data and what is the volatility risk premium. So volatility risk premium is basically the differential between the IV and the actual volatility. So depending on these 2 calculations, the person can take a call that whether they want to do the positional optional selling or not. So in case we want to define what is actual or historical volatility and how it is computed, so we will compute the actual and historical volatility by using the historical data. And once we arrive at the actual or historical volatility, then we will compare the same with the IV or VIX, and accordingly we will take the decision whether the current situation is suitable for option buying or option selling. We will see this in detail with the help of a detailed Excel sheet where I have taken the actual data of the underlying instrument Nifty, and accordingly I have calculated the actual volatility and compared the same to IV or VIX, and accordingly I have derived at the volatility risk premium. Now, in case we want to calculate the actual or historical volatility, so it can be computed in 2 manners. One method is rolling standard deviation, and another is a GK-YZ method, which is known as German class Yang-Zheng method. So this is a gentleman who has developed this method. So don't go by this name. I have basically plotted the formulas used under each of these 2 methods in a separate Excel. And once we plot the actual or historical data of any underlying instrument, basis of these 2 data, we can get the actual and historical volatility. I will put this Excel sheet link in the comment box. So in case somebody wants to download that Excel sheet and do this exercise for any other underlying instrument, say Bank Nifty or any other stock, so they can do the same and do these exercises. So the GKYJ method is more preferable to compute actual or historical volatility as compared to the rolling standard deviation. Why? Because under the rolling standard deviation, we use only the closing data. So if we take the example of the underlying instrument Nifty, there are basically 4 data points for every day. One is the open price, that is the price at which the Nifty opened on a particular day. Another is the high price, that is the price which was the highest for the Nifty underlying instrument on that particular day. Another is the low price, that is the price which was the lowest price point of the Nifty underlying instrument on that particular day. And fourth one is the close price, the price at which the Nifty instrument closed at the end of the day. So there are basically 4 data points: open, high, low, and close. So the rolling standard deviation method uses only the close price data to compute the actual or historical volatility, whereas GKYJ Z method, which is German class Yang method, it basically uses all these 4 data points in order to compute the actual and historical volatility. So this method is more preferable, and I myself use this GKYJ method in order to compute the actual or historical volatility. Whereas a rolling standard deviation method, as I said, it uses only the closing price to compute the same. We can easily download the data from the NSE website of any underlying instrument, whether Nifty, Bank Nifty, or any other stock. It is freely available. Anybody can go and download, and you can plot those data in the Excel, which I will be providing, and accordingly you can derive at the actual or the historical volatility. So once you compute the actual or historical volatility, we can compare the same to the IV, which is the implied volatility, and the difference between these two is known as the volatility risk premium. In short, it is called as VRP. So generally, once we compute on the basis of the historical data, the actual and historical volatility, we will come to know that IV generally is always greater than the actual and historical volatility. So that's why, as I explained in my earliest videos, that options are generally considered to be overpriced. That's why the selling of the options is more prevalent in the market as compared to the buying of the options. You can recall my example of the insurance company, where I have explained the basic of the call option and the put option in my first video under the basic options, a series, where I have said that why the insurance companies are always profitable in spite of them selling as the insurance policies. And I have used that example to compare the same with the person who does the option selling. We can calculate a VRP in Excel. So let me just share that Excel sheet. So we can see this Excel. So basically, I have taken the data from 26 March 2021 to 25th March 2022. I have taken the 1 year data. I have plotted the open, high, low, and close data of the underlying instrument Nifty for each of those trading days. And I have calculated the actual or historical volatility under the rolling standard deviation method. You can refer to column G. Column G, I have calculated 1 month vol. 1 month vol means this is the actual or historical volatility for a rolling period of 1 month under the rolling standard deviation method. So RSD stands for rolling standard deviation method. And similarly, I have also calculated under column I 1 month vol, which is 1 month actual or historical volatility under the German class Yang method. And this column F and column H, which we are seeing, so these are just the basic formula computation on the basis of which the actual and historical volatility has been computed in column G under rolling standard deviation method and under column I under the German class Yang method. So this is bit, so these formulas are a bit statistical. So I have plotted the same. I will be putting this Excel file link in the description box of my video. So in case somebody wants to take this Excel, so they can take the same. I'm not explaining the formula in detail, so it's a bit statistical. So you can see, like as on 31st March 2021, the actual or historical volatility under the rolling standard deviation method comes to 21.42%, whereas under the German class Yang method, it comes to under 90.84. Because German class Yang method takes into account all the four data points, which is open, high, low, and close, in order to compute the actual and historical volatility. Whereas the rolling standard deviation method takes into account only closing price of the data of the underlying instrument in order to compute the actual and historical volatility. And I have also plotted the actual VIX at the end of the day for the Nifty underlying instrument, which I have taken from the NSE website. And I have computed VRP in column K. VRP is volatility risk premium, which is basically VIX minus 1 month vol under GK/YJ method. And at the same point of time, I have also computed the average of the VIX for this entire period of 1 year, the average 1 month volatility under GK/YJ method for 1 year, and the average volatility risk premium. So you can see on an average over a period of 1 year, the actual or historical volatility is always lesser as compared to the VIX. So that's why it is considered that the option selling is always preferable. So I am not giving any trade recommendation of, or I am not promoting the option selling. I am just explaining you what is prevalent in the market. This is the data which is available with us. I have also plotted the volatility risk premium in the chart, which you can see on my screen over a period of 1 year, starting from 26 March 21 till 5th March 2022. So just in order to analyze the data, just see, so like if I consider the data as on 6th of April, so on 6th of April, the volatility risk premium was 1.34. That is, the India VIX or the IB was much greater as compared to the actual or historical volatility. So it means that the option selling was preferable at this point of time. So let's say if somebody would have sold the put or the call option, basically they would have sold the straddle. So if you refer to my options intermediate part 1 series, I have explained the various strategies under the speculation of the discretionary category, where I have explained one strategy named as a short straddle. So short straddle was basically is somebody selling ATM call and ATM put option of the same expiry of the same underlying instrument. Now say at on 6th of April 2021, when the Nifty had closed at around 14,700, somebody would have sold 14,700 a straddle for the April series. Now, if you go back and check the historical data, so on an average, the Nifty straddle trades at a price of around 5 to 6% of the Nifty underlying instrument. So in our case, the Nifty currently is trading as 14,700. So 14,700, if you multiply it by 5.5%, so it comes to around 800 points. So on 6th of April, I am assuming that the Nifty straddle at the end of 6th of April was trading at 800 points. Now going by this volatility risk premium, the situation was ideal to sell the straddle at that point of time and receive the 800 points of premium. So the entire premium which would have been received at that point of time would have been 800 multiplied by 50, because 50 is the quantity of the one lot of the Nifty contract. So this amount would have been 40,000. Now we assume that the person would have hold that Nifty straddle at the end of the Nifty expiry contract of the April month, which is the 30th of April. Now you can see on 6th of April, the Nifty was trading at 14,683. It went up to a high of 14,873. It went to a low of around 14,296, and finally it ended at price of 14,631 on 30th of April. So you can see the Nifty almost ended at the price which was almost same to the price at which the Nifty short straddle was initiated on 6th of April. So if somebody would have sold Nifty straddle on 6th of April at the end of the day and he kept on holding till the expiry of the April month contract, then the entire premium of around 40,000 would have been pocketed by that person on one lot start. And you can see that the VRP, which is volatility risk premium, which was 1.4 on 6th of April, it, it went up to 8 and 9 till 30th of April. So this is just one example which I have given you. It is not necessary that whenever the volatility risk premium is in the positive territory, so the entire premium which would be received in case of the short straddle or in the case of the short strangle will always be become the full profit of the option seller. But I'm just giving you an example that on the basis of determining the actual or historical volatility and comparing it with the implied volatility and accordingly arriving at the volatility risk premium, how the trade can be initiated in favor of the person who does the option selling, and accordingly the person can decide whether the current scenario are more favorable for option selling or option buying. So we have seen one example where the VRP is positive and accordingly this decision was made. Now if somebody may ask why I have taken the 6th April only. To see, in case of 6th April, the VRP was 1.3. So 1.34 as a percentage of the India mix turns out to around 7%. So even though in percentage, so even though in absolute figures, it turns out to 1.34, which is minimal. But if we compare it as a percentage of the mix, it turns out to 6.5%, which is significant. So I generally consider VRP as significant only if it is at least 5% of the mix. So that's why I have taken this 6th April data. Now we will go and see the data and the downwards, and we will try to see where the VRP went negative as well or not. Yeah. See, so on 12th of November, the VRP went to 1.51 negative. Now, if we take this 1.51 as a percentage of the VIX, so it comes to 9% negative. Now, this 12th April give you an indication that the current movement in the Nifty underlying instrument is not suitable for the option selling. This option, this scenario may be ideal for the option. Now, assume that on 12th of November, the person would have bought the Nifty straddle. So instead of going short straddle, the person would have gone the long straddle. Long straddle is basically buying an ATM call and the ATM put option. So it means that the person expects the market to move very strongly in either on the upward direction or in the downward direction, but the person doesn't know in which direction it will start moving. So the person buys both ATM call and ATM put option in order to get the benefit of the significant movement on any one side. Now this is the 12th of November. So assuming that the November month contract expires on 30th of November and 12 days has already expired. So I am assuming the Nifty straddle at that point of time would have been trading at around 3 to 3.5%. So 18,102 multiplied by 3.5%, it comes to 633 points. So a person would have easily bought a long straddle on 12th of November EOD at 633 points. So the total outflow would have been 633 multiplied by 50. So it would have been around 32,000 rupees. Now you can see till 30th November, you can see on 12th of November, the person has bought the long straddle at 18,102 at a price of around 633 points, and you can see at the near of the expiry of the November month contract, the Nifty ended at around 16,980. So you can see there is a clear movement of around 1100 points. So even in case of this long straddle, the person would have clearly made a profit of around 470 points per lot of long straddle, which would have been a profit of around 23,000. So this is again just an hypothetical example basis that how you can use the volatility risk premium and you can accordingly initiate a trade on the option buying or on the option selling side. But again, this is not a trade recommendation. I have just explained you how you can use this data in your favor, and you can accordingly decide which way you have to go, whether you need to go on the option buying side or on the option selling side. So that's it for my side. I hope you have liked my video. In case you have liked, please do like and subscribe to my channel. Also share my content with your family and friends. And in case you have any queries on this video, please feel free to give your feedback and comments in the comment box, and I will try to address it in the next video. Thank you.